Hello, everybody, and welcome to the Lerner Group August investment discussion meeting. I'm Michael Schneider, joined always by JR Gondeck, and a big welcome back to Megan Kowalski after her few-month hiatus. So, Megan, welcome back. We're glad to have you. And kind of, now we're 2/3 of the way through the year. It's been quite a year to say the least. And markets, we started off strong, with inflation, some other things coming in. Markets fell a fair amount, and now it looks like we are, there's a little bit more optimism that we're seeing through here. So, JR, why don't you kind of talk about a little bit more in detail what's been going on this year, really what you're seeing?
Well, Michael, to your point, I mean, it's been a crazy year. It feels like 2 or 3 years packed in 8.5 months in a lot of ways. And when you look at the recent rally, everything and everybody is feeling better, and there's some concern on people's minds. Have we come too far too fast on the recent rally? And as you take a step back and just pause and recap, like you said, where we are, the markets are still down on the S&P 10-11% on the year. So it's come back from the trough of how bad it was in June and early July, but keeping things in context, still down, right? It's a lot better than it is. And as we look forward, there's reason to believe that you could continue to see some optimism around the markets and such, but the concern of coming too far too fast, when you keep it in context, still feels like there's a ways to go as things settle in, and we'll review that over the rest of this discussion. And when you look at the graph here for the market perspective, the roller coaster 2022 has been, to your point, Michael, we started the year at the highs. The first trading day of the year has been the high for the year. And then as we talked about coming into the year, we expected a tougher year, and that first 25 basis point rate hike in March, we kind of thought the markets would kind of settle in and recover from that. And they did for about 4 or 5 weeks. But then the reality of inflation remaining high much longer and kind of out of control with, again, a lot of the events that are outside of the control of the Fed, the war and other things that are ongoing, energy prices and such went much, much higher. And with that, the Fed needed to do a lot more. And that caused a lot of pain in the markets to the point of the June lows, as you see with that 75 basis point rate hike, right? But then from there, you've really started to see things settle in, because a lot of the heavy lifting of the Fed might be the worst part of that is over, right? So as we kind of pause there, I think it's a good segue into kind of keeping things in perspective, right? It's been a good run back up. On the other hand, there's still a lot of deals out there, and the markets are still down, in this case, the S&P over 10%.
Agreed. And JR, I think one of the reasons why this year kind of came a little abruptly was the quick shift in the tone from the Fed. So there are terms that have been thrown around, and maybe not everyone is as comfortable as familiar with them, but dovish and hawkish are kind of what people use to describe how the Fed is proceeding with their policy. And in general, prior to this year, they were not as hawkish. And what that means is increasing interest rates to really focus on inflation. Prior to that, everyone was very worried about COVID. So all they were worried about was stimulating the economy and making sure everything was going to keep moving along. So the quick shift in policy change at the beginning of this year is what drove down the market so aggressively. However, recently, one thing that came up in the most recent meeting minutes from the Fed was a potential shift back to maybe more of a dovish or a soft dovish tone. And that is because they're starting to hint that maybe they won't increase rates as aggressively as they have been. So that has been potentially part of this shift back up in the market, that they could see maybe there's an end in sight or there's a light at the end of the tunnel overall.
That's right. And so kind of as we look at that, we say, all right, well, what can we see moving forward? How is the Fed, if they were saying, all right, well, we need to see how all the prior rate hikes have been baked in, it takes some time for markets and for companies to adjust to the new interest rate environment, that if they are looking to be a little bit more dovish, say, well, maybe we don't need to raise as much or as aggressively, how does that really look? What does that look like for the markets, for the consumers? And when we say, from the bottom of the market, back in June, are we now kind of at this kind of peak of that bear market rally, or is there sort of more room to grow? And with where inflation is right now, last month we had inflation at a little over 9% year over year, and now we're seeing it with the July numbers at about 8.5%. So from a month over month perspective, inflation was flat, but we were able to drop off some of the higher data points from the prior year, which brought the year over year number lower. So if really that is kind of peak inflation, JR, what do you really see from there?
Well, if you look at that, Michael, the Fed is talking tough, right? They want to, these numbers, no matter how you look at them, are way too high. And what the Fed really doesn't want is inflation expectations to get embedded into the economic outlook. And one of the key things that's changed in the last week is that 5-year projection. A lot of the inflation expectations have come down a lot, right? Oil prices are down, you name it, right? A lot of the pressure is over. But the Fed is not going to change their tone, even though the minutes came out to be a little dovish. All the commentary out of all the Fed speak the last few weeks has continued to be, we're going to raise rates until inflation levels off and is down for a long period of time. Nobody knows what that means, but the reality is they're going to raise and want to see this level off. The market doesn't believe them from the standpoint, long-term interest rates, if the Fed raises like the market has priced in, we're going to be inverted from very short-term interest rates, meaning short-term rates are much higher than 30-year interest rates overall. So again, the market is already looking past the Fed. The market believes that we're going to get back to a normalized inflation level much quicker than the Fed is saying, right? And I believe the Fed, just like during COVID, they did a lot of talk about having to buy extra bonds and didn't have to do as much as they said. Just talking about it was enough. And I think that's what the Fed is trying to do. We're to keep raising rates, hoping that they continue to bring down those inflation expectations and ultimately have to do less than they are saying right now. But they don't want the market to believe that they're going to pause any sooner than inflation expectations are totally gone.
Right. And I think what's important to note as well is that when it comes to where inflation is right now, and yes, if we have reached the peak, that's great. But as JR, you said that we're still at a very high number, and just kind of think about some of the things that could keep it at a higher number for longer than we would like would be things that we still have rent that's something that's very sticky. You have oil and sort of energy prices in general that, in July we saw a big drop in prices, so that really had the impact on inflation. But we're not going to get that again, moving forward unless oil goes from say 90 down to 60. So it's those types of things that still could keep the year-over-year numbers in that 7-8% range, and not really, or make it harder to get down to that 2.3 projection, 5 years out.
Now, Megan, let's talk about kind of the earnings season and spending, right? Because we've kind of finished most of the earnings season by this point, and it's been interesting to see a lot of the challenge in the second quarter was the market trying to figure out how big a slowdown was it going to be, right? And we saw pauses and other things, but let's talk about some of the trends we've seen in the retail results and how people are spending now that we've had some more data.
So I think a lot of it has been mixed and somewhat of a surprise. Retail in general has been mixed. There have been companies that have done surprisingly well during this environment and have pivoted, and then other ones that maybe they overbought their inventories and they're going to have to start trimming and taking losses. But most of those have been large enough to sustain the loss. Another item that's interesting with spending differently, though, is I'm sure probably all of us have seen the headline, but it's that eating out is cheaper than the grocery store. And that's another item that obviously inflation has had an interesting impact on certain sectors, some of those being grocery stores, and where in a way restaurants were able to cap their inflation rates and hold that. So spending differently, we'll see that continue to unfold as people assess real time. And I think Michael will dig a little bit deeper into the wealth effect and what that kind of means with consumer sentiment. But I think that's kind of how we're just keeping pace with how people are spending differently and what that means for specific companies, which ones might be able to weather the storm a little bit better than others.
And I think what you're saying, Megan, is what we've seen with the data is there's this fear that the pie would shrink, that collectively the whole pie would be less because of inflation. And it turns out that certain parts are less, but the pie didn't shrink. It is still growing from an overall spending perspective, just turned out to be very different. And then when we think about that, Michael, and you talk about consumer confidence, values are up, things have turned. Let's see what's ahead and look at kind of consumer confidence overall as well.
Yeah, absolutely. So University of Michigan Consumer Sentiment Index is very, I think, a useful tool to look and see really how consumers are feeling about, their own personal spending and sort of where the economy is and how confident they are that things are going to continue to get better. And as you look at this is going back to, about August of 2016, that confidence levels were very, very high up until COVID, where you see the sharp drop. And things continue to kind of progress and get better. But then towards the end of last year, you saw the new variants pop up and things started to fall again. And you had expectations that coming into this year, you'd have increasing interest rates, you'd have more inflation. And you really see how the sentiment just really fell off during the first half of the year. Just people saw how it was happening with inflation, what was happening with the war, just how things were getting tighter. And what is interesting is that the June number for the index dropped down to 50, which also really coincided with the bottom of this current market. So, as we've seen, say, peak inflation, or if we've seen peak inflation, people are being a little bit more comfortable with that. People are seeing things that are seeing that the economy isn't as bad as expected. And again, you kind of say, all right, well, if I feel a little bit better about things, I can start spending a little bit more. From a housing perspective, people still have a ton of equity in their homes. So that just in general, that the idea of the wealth effect is really there, that as inflation comes down, if we're talking about energy prices, say prices at a pump, they're down $1 or $2 a gallon, maybe you save $100, $150 a month, that money is going to be spent elsewhere, but it's also money that people are saving that is going to give them a little bit more confidence to that they're going to be able to really make progress moving forward.
And when you think about some of that, Michael, the labor market is very strong, right? We created over 500,000 jobs in the month of July. And you continue to see that feed into the confidence as well as things have turned. It turned out not to be as large a slowdown as feared. You saw that with a lot of results. And the same thing in the housing. As the confidence picks up, you really had a pause for about 6 weeks, maybe 8 weeks. Existing home sales this morning for the month of July were at a new low for a couple of years. But as you look, those tend to be lagging indicators. To your point, I think with the confidence picking up, the wealth of it, you're going to make those bigger purchases as things were not as slow. Prices have moderated in housing. You should start to see big ticket items pick up in the third and fourth quarters as we get to the end of the year. With that, let's talk a little bit about the recent passage of the Inflation Reform Act and maybe some of the things to look for into next year.
Yeah, so there was a big piece of legislation that came through, and that could have different effects on different industries. So one of the main pushes is for just like greener initiatives with companies and things like that. One nice thing that we could see come out of it is that we would think that it would help families invest more in more efficient heating and cooling or water heaters or anything like that, and getting incentives from that. So we should see certain companies benefit from that, of course, and then also just an overall green push. So that we're expecting to see ahead, as well as some of it will be interesting to see how the corporate minimum tax pans out. The nice thing is they kept accelerated depreciation in the bill. So I think companies might be able to be creative and play with that so it's not as much of an impact on their bottom line. But there are some initiatives that should be a benefit. The last one that we think could help consumers overall is just more spending power. So with some of the caps that are imposed on there on medical expenses and pharmaceuticals in general, that might help just the end consumer have a little bit more spending power and overall consumer confidence, to Michael's point earlier, with spending ahead.
Well, the nice thing with some of those incentives, when you're given incentive to make investments, that's how you can position in stocks or industries or such, especially as you look into next year, because there's no question, to your point, if you can get a couple $100s or a couple $1,000s to upgrade a water heater or something to be more efficient, it's not the main reason you do it, but that extra incentive does motivate your behavior. And when you think about the extra growth and demand that will come over the next few years in some of those industries, they're interesting to look at. And the same thing with the depreciation. You could call it a loophole or what have you, that it is a main reason that companies, or a big reason how companies are able to not pay the minimum tax. But when you look underlying the reason you get the accelerated depreciation is to make an investment today, right? To go buy the equipment, to stimulate today. So both of those should be pretty good factors looking at next year. And from an investment perspective, interesting areas to explore as well. So now as we pivot to the planning, Michael, do you want to maybe give a planning idea as we hit the third and fourth quarter?
Absolutely. So just want to remind everybody with an IRA account to check if you've met your required minimum distribution yet from the IRA. Remember, it's something that needs to be done by the end of the year. And with the returns we've had past couple of years, plus the another year later, the factor used for determining your minimum distribution is going to be higher. That dollar amount that you have to take out might be a bit more than you expect if you haven't checked already this year. So it is something to look at right now from a tax planning perspective. And then again, from a financial planning perspective, remember, you can use your minimum distributions to make tax payments, or if you want to do monthly distributions through the end of the year, or a single lump sum. Just be aware of how it may impact your taxes overall, and if there are any ways that we can help to kind of make this an easier plan for you or make the transaction easier, please let us know.
And then one quick plug as we close up today was we're launching a new podcast series called The Wealth Approach. And we spend a lot of time on conversations like this, focusing on the investments, the economy and such. But the reality as you plan as a family, getting the planning in order is so important. It really ties everything together and in many ways is much more important than the investments themselves. So we're starting a new series to kind of go through the approach, what you need to continue to be in order as a family, how to get set up for a family meeting, how to continue to communicate, what tools and such can you utilize. And then we'll go into some case studies and good, bad stories that we can all continue to learn from to put it all together. So we think it's timely to continue to push the industry forward, to make sure you communicate as a family. The holidays are coming as we get closer to the end of the year. It's a good time to continue to think about these topics, and intentional communication as we talk about is just so important. So look for those in the weeks and months ahead. So with that, we want to thank you for tuning in this month, and we'll touch base in September.
All right,
thank you, everybody.
Thank you.